Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Tuesday, January 3rd, 2023. It's now the 1st. We start off in the S&P 500 daily chart in DeMark looking back to December 2021. I'll zoom into the current area now. The S&P 500 daily chart has printed the combo and sequential buy setup 1 count within this consolidation zone here. And if that keeps up, I expect to see more price flips. So every day we're going from sell setup count to buy setup count. But to negate this for end of day Tuesday on the 3rd, there must be a close above 3829.25 for the price flip back to the sell setup count 1. I still expect more upside. How far it will go is the question. And in the immediate time frame, it looks like the Fortress Fed resistance at 3900. So right around this qualified supply projection, and the only level in danger of becoming qualified is to the upside, this 50% momentum up level with a close above that level end of day on the 3rd. So price will have to make the decision, are we going up and get the momentum to the upside, or will the momentum go to the downside? We're in this consolidation zone, but still under the auspice of this ATM pullback alert, which I have always seen to eventually go to the upside, but this is getting long in the tooth. It's usually a few bars after it prints, it heads up, so we're getting way more than that. And it is subject to a fail now. The sequential sell countdown 13 did print back here on the 13th, and there has been a nice pullback to the downside, so that's another reason to think there will be more upside along with this ATM pullback alert. And another reason to expect more upside is that the qualified demand projection was pretty much tagged on this bar about 20 points away, but that's close enough. And the last reason to be hopeful for some more upside is the intermediate term volume oscillator for the NYA. Looks like it's hooked around. If it can get back above its 10-period simple moving average, that would be a definite reason why to expect more upside. Along with the intermediate term breadth oscillator, it wants to hook around to the upside, so if it can get above its 10 simple moving average, that's another reason to be hopeful for more upside. And this coming week's economic reports will all matter, starting with the S&P U.S. Producers Manufacturing Index, the ISM Manufacturing Index. I'm giving up on the ADP employment report, so I would not pay any attention to that. And what would be more important would be the initial jobless claims, of course, along with the continuing jobless claims. And then on Friday is the big one, the non-farm payrolls report. So price in the S&P 500 could go sideways until Friday. And the worst case scenario for the S&P 500 would have price get lower than this low on the 3rd for the D wave up wave 2, and the 2 will shift over to where the 4 is and negating the 3 and the 4, and then keep going and get under this low 3491.58 where the D wave up wave C printed, and that will shift the C over, and the S&P 500 will start its climb upwards all over again. However, that means the C could keep traveling downwards indefinitely. And not much has changed on the NYA top caller chart since last week. Price is still above the support and resistance green line here. So we'll take some extra time and focus on the NYA to SPX ratio. Here's the NYA to SPX ratio looking back about 60 years to 1963. And we'll focus at the area here, which is the pre-dot-com bubble. So you can see the exuberance for tech stocks as the NYA to SPX ratio was favoring growth, and growth was trouncing value. And then the dot-com bubble burst, 2000 right here. And then value had its day in the sun for several years until the financial crisis. And then the Fed started QE1 here, and the rest is history. QE2, QE3, I forgot what we're up to, QE4, QE3 I believe. And that brings us down to the beginning of 2022. And you can see the nice bounce off this here, and it's headed up to that 4.0 line I have drawn in the daily chart. And that would be right here, right above the 3.97 line or so. And you can see that recently there's a rollover, so growth is really stretched to the downside, and the value play is really stretched to the upside. So I could see a bounce up for growth. And that's why I say there's a good chance for a bounce to the upside for the S&P 500. But I don't think it's going to make it past the 3,900 Fortress Fed resistance. We'll look at that later in the support and resistance board. So in the worst case scenario that I've described in the DeMark Indicators section of the video for the S&P 500, this ratio could get up to 4.51, 4.64 zone here. You can see that it's at the dot-com bubble crash, and the 2018 one roll off too far for the Fed, so it had a nice bounce there. So that's the bottom of the zone there, and then up here there's a spike down there and one here, so somewhere in that zone. Get through that and start heading up, and then there's another zone here, 4.85, 4.91, and we can gauge those NYA to SPX ratio zones with Apple. Here's the inverted cup and handle chart. So down to 115 would bring us to, I would say, this 4.51 area or somewhere close, and then keep going, and that's for the handle measurement rule. So then I measured the top of the cup down to the base rim here, down to where it broke through and moved the ratio over, and that's 23.7%, and that could bring us roughly up to this 4.85 zone. Again, those are estimates, but probably very close, I would say, for where Apple could take us. And the best case scenario for the S&P 500 would be if Apple can break above its baseline here, the inverted cup and handle rim, and that's right around 135, and then get past that, get above this downtrend line and start moving up, get a couple closes above that, and I would say that's the best case scenario, and this whole nightmare period that was 2022 will be over. The S&P 500 support and resistance levels big board chart shows the gray areas at R1 and the baseline 26 bars back concerning the lagging line. Price in the aftermarkets closed on Friday evening at 38.45, and to the downside would be the daily conversion line, the pivot point, and the weekly channel 3 low. So what we're concerned about moving forward is the upside. So to the upside is R2, and then the trend factor down 2, and then the daily horizontal support from 01/26/2021. Get through that, and we're approaching the daily fortress Fed resistance at 39.06. And if price can punch through all these levels I have highlighted as an up target here in the next few days, that will be nothing short of a miracle. So first is the 50 EMA, then the weekly conversion line, and the weekly diamond bottom extension perfect uptrend channel. Then we're getting to the 100 simple moving average, the daily high channel 3, the top of the cloud, the weekly baseline, the top of the cloud 26 bars back concerning the lagging line, the actual fortress Fed resistance at 39.06, and this daily qualified supply projection. So if S&P price can start making it towards this weekly diamond bottom extension perfect uptrend channel, and for those of you who are unfamiliar with that level, that's this first pink line here, and then there's a second one here, but this is the first one to get over that weekly diamond bottom extension perfect uptrend channel. So I'll be fading the market once it starts approaching that, and then continuing if it actually tries to make it up near this daily fortress Fed resistance. I'll be fading all along the way there, and if it looks like it's going to punch its way through all that, then I'll start buying instead. And you can see the video that was dated for 12:30, the Let's All Gather at the River section for the rules for buying there. But if it starts doing that, I'll just start buying then and there and worry about the rules later. And the NYSE traditional McClellan breadth oscillator is close to getting back above zero. It's at 466 advanters required over decliners to get back to zero. So that's very close. Have a great day.